Some of you have actually seen some of them around before. Some not so familiar faces in our presentation today. But what we're going to start with is give each one of them about 5 to 7 minutes to just share a little bit about themselves, about their journey here, journey in investing, so that instead of me introducing them, let them introduce themselves to you. Could I start with Alvin, please? Thank you.
Thank you, Richard. Thank you, everyone, to be here on a Saturday evening. It is always good to see people very keen about investing. So my investing journey actually started when I was age 20. I was going to the bank with my mom on a Saturday morning, and while we were doing some banking processes at a counter, a lady came to us and invited us for a seat. And thereafter, you know, the sales pitch typically starts, right? So that's the kind of a relationship manager that you always encounter in the bank. And at that point in time, I have never invested a single cent in my life. So the relationship managers will have to go through certain questionnaire to figure out what's your risk profile and things like that. So I said, oh, I'm very conservative, I cannot afford to lose any money. And so she recommended Shenton Income Fund, okay, for example. It's a bond fund, right? So it's capital guaranteed in a sense. But you don't expect to have a lot of returns, okay? So after 1 year, I didn't lose money, okay? So I received a check of like $25, right? As an interest payment for my investment. So I actually made money for my first investment. I didn't really do much thereafter until I was probably around my uni days when I was about to graduate. That's where I started to save quite a sum of money, and I wanted to grow that even further. Okay, that was during the period of 2007. Do you remember what's happening in the market in 2007? Was it very bullish? It was, right? So it was a period, right? Even if you are a lousy investor, you'll make money. Okay, whether you're good or lousy, you'll make money. All right, that's how easy it was. So whatever you buy, you'll make money. And during that time, right? You know, I just want to be more. I'm not so risk averse at that time. I wanted to grow my money fast as much as possible. So instead of buying stocks, right, I went to buy warrants. You know, structured warrants. They are leverage products, all right. And during that time, shipping industry was very hot. So I bought this Costco Corporation warrant, and 1 week I doubled my money. And I think that at the point in time, I thought that I don't need to study anymore. You know, I don't need to look for a job anymore. I can just do this for the rest of my life, all right? But you know, luck can predominate in the short run. Okay, so after a few weeks, I didn't really make money consistently after that. So, which was a good thing because I escaped the entire, you know, the downturn in 2008 financial crisis, all right? And then thereafter, I started to learn that it's very difficult to make money consistently, okay? So I went to try a lot of stuff, Forex, options, commodities trading, whatever, you name it, I've done it before. So it was after a while, then you start to gravitate towards a strategy that is more suited to your personality. And right now, I would say I'm more like a value investor. So I don't take leverage, and I buy stocks at the value as low as possible. So that pretty sums up my journey as an investor today. All right, thank you very much.
That's interesting, Alvin. I think, given the fact that at 20, you were seeing a relationship manager is seeing you, you must already have quite a fair bit in your account.
I would say that they are probably more desperate for sales, you know. So we were just like a very vulnerable target that was very easy to...
Oh, they thought you were an easy target.
Yeah, I'm an easy target. It's not that I was loaded, yeah.
Okay, we'll come back and we'll talk a little bit more about you. I'm going to just get the participants to share a bit about themselves, and then we'll talk about certain topics and things. David, would you like to share? I think we've had you in this. We've got some new people we had at here today. So we'll just start with you to share a little bit more your investment journey. I think we've got different age groups here today, so it's quite good to have. So we start with some a lot younger, and maybe David, a little bit more longer term, perhaps.
What are you referring to, Richard? What can you possibly be referring to? I have no idea what you're actually talking about.
Different life stages here.
Okay, right. My investing journey started around the 1980s. And if you are old enough to remember, in the 1980s, in the UK in particular, there was something going on called the Big Bang. And the Big Bang was a liberalization of the financial industry. And what happened during that time was that brokerage charges started to come down, banks were able to sell shares, and you didn't have to go to a specific broker in order to buy and sell investments. So during that time, every time you turned on the TV set, every time you opened a newspaper, you would see lots of news, lots of stories about people making money in the stock market. And it seemed like a very easy way to make some money part-time. And that was essentially what I did. I went to my bank and I opened up a brokerage account. It took a couple of days for it to set up. And then once it was set up, I was ready to start buying shares. But unfortunately, like most people at the time, you didn't really know what you were buying. So what I did was I looked at the newspaper, scanned down the newspapers, and I found a company, a construction company, whose shares were selling for about 30 pence. And I worked out that I had around £1,000 to invest, and 30 pence share sounds pretty good. Because when you phone up your broker, and you have to remember at that time, you had to call up your broker. There was none of this internet trading that was going on. You had to call up your broker. And nobody really wants to call up their broker and say, can you buy me 10 shares or a couple of hundred shares? You want to sound like a big shot, right? So I worked out, if I bought these 30p shares, I could buy 3,000 of these, right? So I phoned up my broker and I said, buy me 3,000 of these Costain shares. And I felt really good. And these shares cost, like I say, around sort of 30 pence. I got them for about 32 pence. And I was quite delighted. Also at that time, many of these brokers set up these things called premium share lines. And what you can do is you can phone up this number and key in the code, and it will tell you what your share price is. I mean, they charge you some money for doing it, but it was okay. So I bought these Costain shares for about 32 pence. When it went up to 33 pence, I felt good. Yeah, I thought, right, I've made a penny a share. Went up to 34 pence, I felt absolutely delighted. Then it fell back down to about 30 pence, and it wasn't so good. So I was constantly calling up this premium hotline to try and sort of get the value of my shares. Eventually, it went up to about 35 pence, and I thought, right, okay, after a couple of days, I've had enough. I'm going to sell these shares at 35p. I made 3p a share, 3,000 shares, that's £90. I mean, in the 1980s, £90 was a lot of money. So then came the bill, right? So I made £90. It cost me roughly £50 dealing charges, so I still had £40. I thought, that's not too bad. Yeah, £40 is okay. And then at the end of the month, my telephone bill arrived, and I had this huge shock. It was costing me so much money to phone up to try and find out how much my shares were worth. By the time I deducted the £50 calling charges, I'd actually lost money. And so I thought, there's got to be more to investing than this, right? So I must be doing something wrong here. And then it dawned on me, it's the charges that is actually killing me. The shares were doing okay, but it was the charges that was actually sort of taking all the fun away from investing. So back in the 1980s, I started trying to figure out, what it meant to invest. What does it actually mean to be investing? And I read lots of books. And for the next 3 or 4 years, I was trying different styles of investing. I tried value investing. I tried growth investing. I tried some blue sky investing, I tried some income investing, and then I eventually settled on income investing. I said, this is my style of investing. I actually understand this. And so I became an expert in income investing. And that's not the same as high yield investing. Income investing just simply means that you are getting paid for buying those shares. And so that is what I've done. And today, I can actually look at a company, I can work out whether or not it is good value, I can buy the shares, and guess what? I don't have to check on the share price all the time, because every 3 months, I get paid dividends. And my joy is actually watching those dividends come in every 3 months. And here in Singapore, I've built a portfolio of income-generating shares, and my biggest headache is every 3 months. Because I have all of this money that I need to reinvest again. And it is the most enjoyable pleasure to actually sort of look at this money and say, I need to invest. And you know what? When you reinvest it, you end up with more shares. And then the next quarter, you have an even bigger headache because you've even got more money to invest. And it, as far as I'm concerned, it's just a nice problem to have. So there you go, Richard.
You seem to have lots of headaches, I see. We'll ask more questions, and David as well. Could you get Brendan to share a little bit more about yourself and your investment journey as well?
Yeah, certainly. You know, the way it's arranged, it seems that I'm the oldest of the three. Yeah. Okay, my investing journey starts off this way. I bought my first share, not because I'm interested in investing. In fact, I have no interest at all. I bought my first share because of a need. You know, anybody here knows this share called SBS Bus? I'm quite sure some of you all know. SBS Bus was a predecessor of ComfortDelGro Group. Yeah. I bought it because it offers us, for shareholders, you get a bus stamp, and you pay $40 and you can take the bus, you know, whenever you like. Yeah. I did that because my place of work and my house was quite far away. So I did that, and it was a very good investment that at a point in time, that was 1988. Anybody knows about 1987? What happened to 1987? Crash, right? That was the Black Monday, right? In US in one day drops 21%, right? The next day, Nikkei, Hong Kong, Singapore also crashed, right? 21%. Right? And it didn't stop there. It went down all the way until December, somewhere in December 1987, right, before it started to come back. So when I bought my first share, I was actually riding on the upside of the wave. I do not know, unfortunately, because in fact, that was the stage when stocks investing is the best time during the 90s. Yeah? Late 80s to the early 90s, the best time. Right, and you remember about the Asian tigers, right? Singapore is one of the few so-called 4 dragons and 5 tigers, right? And because of this Asian story, a lot of money are coming into Singapore and the stock markets in not just Singapore but Asia. Huh? And the other thing that actually sprang up the stock market was the government release the CPF, right? They allow more CPF to be used for investing. And that actually boosts up the whole stocks investing. I happen to be the beneficiary, right? I bought the share at $3.08, and I sell 2 years later, just before the Gulf crisis. That was 1990, right? When Saddam Hussein marched his troops into Kuwait. I sold it just before that at $6.64. Is it good or bad investment? Not bad, It's more than 100% in 2 years. And that's how I started. Well, the whole thing is that I did not capitalize on the situation very well, because if I were to do a little bit more hard work, do more due diligence, I could have done very well, but I didn't. I'm just trading my way, right? Then came the Asian financial crisis, right? And it wiped out all my stocks, right? In the process, I lost more than 100,000, right? Imagine when we graduate from school, how much is the pay you have as a graduate? $2,000, right? Of course, over the years, you get increment and so on. So you just imagine for the next 10 years, you want to save 100,000, is it very difficult? Very difficult, right? And then you have families coming up, and then you have all the various responsibility. And the crash actually wiped me out, right? After that, I stopped there for a while, right? I went into gold, all right? Now, the first time I went to this bank, I will not say which bank is it, but you probably can know from it. I wanted to buy gold, called this fund, Gold and General Fund. I'm not sure you all know it, right? It's still there, right? But at that time, when I tell the counter, I just want to buy $2,000. the counter lady wasn't very happy. She said, why you buy gold? You should be buying some other stocks. What is at that point in time, what is the good stocks then? Or what is the theme then? Late 80s. No, the general theme is technology stocks, right? Right? Technology stocks were up and up and up, you know. So there were some kind of argument, you know. I was telling him, just want to buy gold, and he was trying to tell me to buy technology stocks, right? I make a right move, all right. Just a few months down the road, the technology stock went up to the highest point, NASDAQ, I'm referring to, 5048. That was, I just picked out from a paper, that was in January 2000, 5048, all right? And just 1 year after that, it drops to 1923, 60% down. If that is not if that is not bad enough, another 2 years later, it went to 1273. All right? But luckily, I did not listen to the counter lady. I bought the gold, and it was inching up. You know, it's not fantastic, but it was going up. And that provides me a second level of confidence. And that's how I get back into shares. All right? And from there on, I don't look back anymore. All right? I have hit my 7 million target. All right? And this is where I am now. Yeah, 10 years after that. Yeah.
So obviously, we've all had some challenges. And I think Brendan started this as talking about challenges and how do you overcome it. You know, I mean, I think Brendan started this. Alvin, what are your thoughts on some of the challenges you had to this investment journey? And how did you overcome these challenges? I'm sure they would, these issues are not only faced by every one of us. So what are some of the challenges you faced and how did you overcome them?
I think the first challenge that I faced was I was very overconfident, right? But at that point in time, you will never be aware that you're overconfident. When you're in uni and you just study, you know, life looks so good, so perfect. You know, just going for a very long career, successful career, and things just look so rosy, and you have a lot of confidence. So you bring this confidence into the stock market, right? That's where you'll make a lot of mistakes. That's where I made a lot of mistakes. So that's the first challenge that I had. And the second challenge that I had was, there are so many things, so many strategies out there. Each and every guru will say that, oh, my strategy is the best, you have to follow me, right? But then after a while, you realize that what is true for them may not be what is true for ourselves. Okay, so it's very contextualized in that sense. Analogy to Kung Fu, right? There's not say that Taekwondo is better than Karate. You agree with me, right? It's how good the person actually learned that skill in that style, right? So which means whatever strategies is also the same thing. It's how good you can harness that skills within you. So then I start to realize that it's not what you seek outside. It's actually what you seek inside that makes the difference as whether you're a successful investor. So there has to be a lot of reflection about what you have done, and you must have the humility to accept that you're not perfect and you're very biased in your investment process and your investment decision. So in that light, right, then I realized that it was more about knowing that we have flaws and trying to minimize the bias in the process as much as possible. It's impossible to eliminate everything, but we want to minimize that. And that itself will make you a better investor. That's through my experience.
David, what about yourself in terms of how did you overcome the challenges? I think, you know, I mean, by the time you didn't immediately get straight into income investing, even though some people may follow him to do that.
Okay, I think one of the biggest challenges for any investor is to understand that every stock, every company that is listed on the stock market has a value. And your job as an investor is to understand the value of that stock. Whether you arrive at an answer through value investing, income investing, growth investing, you have to appreciate that it has a value. So this bottle of water has a value, right? let's say it's $1 a bottle. You've worked out that this bottle of water to you is worth $1. Now, if you go into the supermarket and you find it selling for 50 cents, you would then say, this is good value for money. And if I have $1 in my pocket, I will go and buy 2 bottles and I'll put it at home because I know it's worth that to me. Now, if it was selling for $1.50, you would say, no, you know, I'm not going to buy this because I'll wait until the price comes down to something more reasonable. And the moment you understand that, the moment you get that light bulb moment that says, I know how to value this stock, then you would be very comfortable about investing because you will have cracked the one thing that people don't understand about investing. Many people invest because they say the share price is going up. So this bottle of water is $1. Then the next day it goes to $1.10, then it goes to $1.20. So you think panic, right? I better buy this before it actually gets more expensive. But unfortunately, you've missed the whole point. This bottle of water is not worth $1.10, $1.20, or $1.30. It's only worth $1. So you don't want to buy it until it is actually below what we call the intrinsic value. And if you understand that, then you will be so comfortable with investing because you don't care what happens to the stock market because I bought this bottle of water for 50 cents. If it falls to 40 cents, I'm not going to feel any worse because I've already got it at a good price. And that really is the secret of investing. And that is why when I buy shares, after I've bought them, I don't really look at them ever again. I'll look at them every 3 months to see whether or not the quarterly results agree with what I think is the path for the company. And as long as everything is doing okay, I am happy. I sleep well at night. And whatever you buy, make sure you sleep well at night because you need a good night's sleep.
So what is your style of investing, Brendan?
Yeah, I agree with Alvin. Yeah. The first thing when we come out of school, we tend to be overconfident. We tend to think that we are better than the stock market. And that's always the problem. And the worst thing is that we get a first success. And that's always, you know, once you get a first success, the next one, you know, it tends to be worse and worse and worse, you know, until something hit it and we get it out. Yeah. Now, I agree with this David. Now, one of the challenges is really to make sure that whatever stock that we buy has a value. And you have to buy value that is comfortable to you, all right? And not to chase after the stock price, all right? Just look at shares in, let's say, China or even Costco, in fact, just not so long ago. Costco was selling, what, trading at $7, $8. And now, how much is it now? 49 cents, right? 50 cents, right? 90%, it lost 90% its value. It's not just Costco, there are many others, right? If you buy a stock and every day you have to go to the screen and look at it, how much is it worth? I think it's not worth investing in that stock, yeah? Of course, the next challenges is because money is very, very cheap now. Cheap in the sense that, you know, we put in the bank, all right? It don't really give you a lot of interest. And that is why a lot of money are flooding into the stock market and so on and so forth. Yeah? So this is one of the challenges because we don't know what to invest. As what David says, you know, every 3 months when he gets the dividend, he's not able to reinvest the amount, the money. Yeah? So these are the various things that can happen, right, to us.
Brendan, since you brought up Costco and China, I think I'd like to get your comments in terms of the current trends. You know, I mean, we already hear a rally in China. What are your thoughts of the rally in China, and, you know, and why is it not translated to some of the S-chips and, you know, comments? Why is it not translated in S-chips in Singapore? Obviously, we have the disclaimer here. I will say the disclaimer first. All these are only, we are not giving any advice. Huh? These are only suggestions, and everyone here is giving their own comments, and they are not, doesn't mean you go out and buy these stocks tomorrow, okay?
Now, obviously, for Chinese stocks, I would think that it is, I can put everything under this one word called expectation. All right. If you look at, I just flipped through today, yeah, the Today newspaper. China economy actually in last 2 years or so, it wasn't doing very well. All right. The governments expect it to have something like 7% and above in order to have high employment level. Unfortunately, they are not able to achieve that. All right. But then the bad news for the economic front is good news for the stock market because people are expecting bailouts, government to pump in money, So as a result, people are expecting, all right, the interest rate to be lowered just because, in order to prop up the stock market, yeah. So when stocks are not supported fundamentally, but by just money coming in and out of the economy, chances are it's easy come, easy go, right? If you look at the stock market of, let's say, SSE, it was it's currently, I think 4,200, right? But just 1 year ago, it was somewhere around 2,000. Just within 1 year, it has increased 100%. So it's an easy come, easy go situation, right? And if you look just back 2 or 3 days ago, it was kind of dropped, right? So just be careful, yeah? If something that is not supported fundamentally, well, it's easy come, easy go, yeah?
David, what are your views in terms of, we've seen China rally, but, not so much seen in Singapore in terms of the S-chips are not seeing these results?
Okay, the one thing I do when I look at a market is to say how expensive is this market. And when you have a look at Chinese shares at the moment, they're trading on what we call 22 times earnings. In other words, you are paying $22 for every $1 or kwai. You're paying 22 kwai for every 1 kwai of profit that Chinese companies make. So that roughly translates into what we call an earnings yield of 5%. And what that means is that if the Chinese companies, if all the Chinese companies listed on the Chinese stock market were to pay out their profits in the form of dividends to shareholders, you would end up with 5%, just roughly 5%. In Singapore, you're paying $14 for every $1 of profit the Singapore companies make. So that is what we call an earnings yield of 7%. So essentially, you are comparing the Chinese market with the Singapore market, and you would say, which one is the more expensive? The answer is the Chinese market is more expensive than the Singapore market. So why would anyone want to invest in the Chinese market? That's not a rhetorical question, by the way. That's just a question to everyone. Why would you want to invest in the Chinese market? I would not want to invest in the Chinese market at that price. I would much prefer to invest my money in the Singapore market. And as an investor, you are constantly, or you should constantly be having a look at where is the best place to put your money, China or Singapore? And I would say the answer is Singapore, not China, simply because of the risks that are involved in China and whether or not the risk in some ways reflects the rewards that you will be getting. And I would say possibly not. So I wouldn't go into China at this time. Years ago, I would have, when the Chinese market was at 10 times earnings, yes, I would, because then you would actually be on an earnings yield of 10%, and you would say, yeah, to take that kind of risk, I would be rewarded significantly.
I was reading a Bloomberg report a couple of days ago talking that, in China today, the number of I think they were talking about 4 million accounts open per day. In terms for trading of stocks, and a lot of them are traded via margin trading. So I am not mistaken that this is really fueling this. It's more like credit. So it's...
Okay, but I just want to make one point also, that just because a market is expensive doesn't mean that there aren't cheap stocks within that market. You can have a very, very expensive market trading at maybe 20, 30 times earnings. But as a stock picker, you would be having a look and saying, is there anything cheap in there? So going back to the analogy of the water, you can go into the most expensive supermarket here in Singapore and see lots of things selling at ridiculous prices, steaks at prices that you would never possibly buy. And then suddenly you find this bottle of water at 50 cents. And you go, hey, somebody's made a mistake here. There is actually some value in there. And the same with the Chinese stock market. So investing in the market is totally different to investing in particular stocks. If you look, you will probably find there are some very, very reasonably priced shares in that market that would be good if you were a private investor, not if you were investing in the entire market.
So a lot of people say that with the rally in Singapore, with the shares, the STI index has gone up by so much this year. Are we overpriced? Is there value in Singapore? How do we look for value stocks on SGX, for example? Alvin, how do you?
One of the simplest way to find undervalued stocks, like what David has mentioned, right? That even in a generally expensive market, you can always find cheaper ones. So one of the most effective ways is to use stock screeners, right? You can use the very basic fundamental ratios like PE, price to book, kind of stuff. That's one of the quickest way. Else, you can always read, Motley Fool's or some of our articles to get some ideas about what we are looking at. I think that's because most people won't have the time to really pour through every annual report every day after work, right? Most of you prefer to watch Korean drama rather than read annual reports. So that's the truth. So there are ways to shortcut that kind of idea generation period. But thereafter, of course, due diligence is still important. You shortlist a few ideas, and you still need to look deeper into it and take care of your risk profile and what kind of stocks are you getting into.
I think one of the key challenges is the risk in terms of value traps. How do you avoid things like that?
My style of value investing is really looking at very small companies listed on SGX. They tend to have less analyst coverage, which means the funds don't buy these kind of companies, right? So there's a higher chance of undervaluation in these companies. And like what Richard rightly mentioned, these companies are very vulnerable to become value traps, which means they are cheap, but can stay cheap for very long, right? So one of the more effective way that I found, it can get a little bit technical here, right? It's the Piotrowski F-score, right? That's where you can actually apply to see whether a company has a higher chance of turnaround. So these are some of the additional metrics that you can look at. And this Piotrowski F-score, I think if you subscribe to a certain data services, you are able to get it. So you do not need to calculate it by yourself, all right? So that's one of the effective ways.
I think one of the key questions, when you brought about CPF investing, a lot of people have money in CPF. Would you use CPF to invest in stocks? What are your comments?
Well, I mean, if you think that you are able to beat the CPF rate, definitely yes, right? Because CPF gave what, 2%, right? And if you think you can invest more than 2%, which I should think so, yeah, because the general dividend yield should be around at least 2%. Even for growth companies at 1 to 2%, yeah, for dividend paying company maybe 2 to 3%. Yeah? So we should expect CPF, or rather, we should be able to achieve better than the CPF rate. But having said that, it is still more important if you have SRS, all right? It's better to use the SRS because SRS pay you bank rate, right? And SRS, you cannot take it out, right? You can only take it out upon maturity, right? So, and you have to put that for long term. Huh? So if you use that for long term, why don't you use that to buy unit trusts or investing or stocks investing or buy ETFs, right? For a long-term investment, or rather long-term saving for a long-term investment, I think that is a better way to invest. Yeah, right. For CPF, generally, stocks should be able to beat it. But then remember this: CPF is a certainty. The payment that is given to you is a certainty, whether it's 2.5% or 4%, current savings account or special account. Yeah, it's certainty. But stocks is not a certainty. So if you buy a stocks hoping just to beat CPF rate just by a little bit, I think it's not worth that effort. Yeah, unless you can beat at least 3 to 4%. Right? The premium should be at least 3 to 4%. Yeah.
We've got a couple of questions here from the participants talking about the U.S. stock valuation. And according to Janet Yellen, says that U.S. stock price is high now. What are your views? And what are your views on this? And what do you see of any investment themes coming out for the next, for 2015? Maybe we'll start with David.
Okay, first of all, Richard, I didn't realize that Janet Yellen was a stockbroker. I always thought she was just a central banker, but we learn something every day. Now, Janet Yellen...
They want to be stockbrokers.
Janet Yellen is partly right, but unfortunately, the high valuation of stocks is of her and also her predecessors doing. What they did was they cut interest rates in the UK to such a low level that it forced people to look at different places in which to invest their money to get a decent return. So first of all, everybody went into the property market because they understood the property market. And they pushed up property prices to such a high level that the rental yields that you get from property was almost insignificant. And so suddenly everybody then went to go and buy bonds. And then they all piled into US bonds, German bonds. And up until about last week, we saw that some European bonds were producing a negative yield. In other words, you were actually paying these countries to take your money, to borrow your money. I mean, that is just the most ludicrous situation I have ever seen. It's a bit like me saying to Brennan, I want to lend you $100, right? There you go. And at the end of at the end of the year, you give me back $98, that's fine, yeah? I'm going to lose 2% on that. That just doesn't make any sense. I mean, who did that? Well, Janet Yellen did, and also the Federal Reserve did, and the European central banks have done that. So it's very rich for her to actually say that stock markets are overvalued. The problem is there is nowhere else for people to put their money, so consequently they go into the stock market. But again, I have to reiterate that just because a stock market is expensive doesn't mean that there aren't cheap stocks in there. If everybody piles in to go and buy one particular company, for instance, biotechnology, or going in to buy companies in the tech sector, of course it's going to get expensive. But there are still lots of cheap stocks in there. And what I really want to sort of drive home today with regards to investing is, just think about this, right? I have $100, and I take $100 and I go and invest it in something in the stock market. And these companies produce for me 6% dividend yield a year, right? So in other words, I put $100 in, every year I get $6 coming back out. The next year, because the dividends have increased, I get a little bit more than 6%. I get maybe sort of $6.20 coming out, and I keep on doing that. But I keep the investment as it is, the original $100 that I actually put into the shares that I buy. At the end of 10 years, I will have actually got roughly about $60 worth of dividends, and if the dividends were increasing, I might even get a little bit more. Now, the one thing I haven't actually told you about, or even spoken about, is how much did I pay for the investment, apart from telling you that I sunk in $100. I didn't tell you what I bought, what the unit price of the shares were, or how many shares I bought. All I said was I put $100 into an investment, and it paid me 6%, and then 6.5%, 7%, so on and so forth. And that is the way you need to think about investing. Forget about, you know, the daily price movements of companies. If I go and invest in a company, and that company is rewarding me every year, and it keeps on paying a dividend, do I have to keep on going and have a look to see what the stock price is? I shouldn't. I shouldn't really need to worry. Because at the end of 10 years, if I want to do something, I can actually sell the stocks, right? As long as it keeps on. But the question is, why would I want to sell the stocks in the first place if it's doing so well? It's like the goose that lays the golden egg. It keeps on laying these golden eggs. I don't really want to know how the goose is actually doing it, you know, as long as it keeps on laying the golden eggs. And at the end of, say, 10 years, if I want to do something, I can sell the shares and then get my capital back. But in the meantime, I will have got my capital back through the dividends anyway. So I will have got my money back plus all the rest. And if you think like that, then you will actually become a better investor, Richard.
Alvin, some of your comments, you were talking at the US market prices, equity prices being very high. What are some of the themes for investing in 2015?
I guess what we have been driving across today is pretty clear. We don't really care about where the market is going, right? So it is more about price is what you pay, right? Value is what you get. You just need to focus about the value and whether you can get it, buy that thing below the value. That's what we do. If it's overvalued, then you just don't buy it. It's easy to say, it's very hard to do, right? Because when you see the US market is going up, Nasdaq is going up, Facebook is going up, everybody gets very excited. Everybody wants to get into the ride as soon as possible and come out, with a handsome profit. So it is you need to really understand that all this, you can do it once through a stock tip, you can get it handsome profit once, but can you do it consistently? I think that is the challenge that we need to ask ourselves. If you can't, and most of the time you won't have time to monitor the market, right? And it doesn't make sense to keep chasing prices and prices and prices and prices. So just focus on the value and stay with that discipline, right? So I personally don't do market outlook forecasts. I don't position my investments based on those stuff. But I think one important element is that always have some cash in your portfolio. When opportunity comes, it always become very handy.
Brendan, I'm going to ask you this question because we've been talking today, investing, trading. Now, what are your thoughts on trading, and do you trade as an investor?
If you seriously ask me whether I trade, I do, but I trade only a very small portion of my portfolio, really. Yeah, most of my portfolio are built up from very low price, and until today, I'm still keeping them. And I'll probably keep them whenever it's possible. I do trade, but I trade only a very small portion, probably only 10%, if you ask me. Yeah. So, in fact, I depend very much more on dividends than on trades. Yeah.
Alvin, trading, younger people, especially younger ones, are looking to go. So, I mean, what are your thoughts on this? It's very itchy fingers, because nothing to do trade. So,
yeah. Totally agree with that, Richard. I started as a trader. I spent quite a number of years trying a lot of strategies, doing this and doing that. What if I can do this? I get this amount, back test. You'll see a lot of things. But at the end of the day, it is still very difficult to achieve a consistent result. Let me put it this way. So throughout my years with interaction with traders and investors, right, I can safely say that I meet more successful investors than successful traders. All right, that is the statistics I got. Okay, and the risk exposure is definitely different between a trader and an investor. Definitely, a trader has a much higher risk exposure because of leverage. And leverage, because traders will always talk about risk management, do not risk more than 2% of your total account, you must cut loss and these kind of things, right? It's very easy to say, because you expect yourself to be rational in the heat of things. So personally, I can tell you that I have lost $100,000 in trading before. Okay, wipe out within few days, all right? And you can be successful trading for 1-2 years, with your strategy, making very good money, but you can wipe out in days, all right? And I've heard stories, even past SGX floor traders tell me stories that how they blow up millions of dollars within few days. Okay, that's how scary it is. So if you want to trade, you need to really have that kind of discipline without fail. And traders always say this, you're only as good as your next trade. Whatever history of success story that you have is not counted anymore, because the next trade you can just lose everything. But for investor, it's different. Whatever your history is, it actually proves that you are going to more likely to get that kind of returns in the future.
Sorry, David, we don't have much time soon. I'm just going to ask you this one question and round up. Because banks these days are coming up with a lot of plans that you can buy as a regular saving plan that puts into blue chip stocks. What are your opinion of some of these plans?
Okay, I'm going to be very honest here, and the answer is very, very straightforward. We all need to do something with our money, because if you don't do something with your money, you're not going to have enough when you need it, right? You have to do something, and you have to do something for the long term. For some people, picking your own shares, building your own stock portfolio is the right thing to do, because you have the time, you're willing to learn, and you have the expertise. For other people, it is not, because you neither have the time nor the expertise or the willingness to learn. But you still need to do something with your money. Brendan was absolutely right. If all you're going to be getting is 2% on your investment, it is not going to be enough when you need to retire, when you need that money later on. If your money is only growing at 2%, it will take 36 years for it to double in value. In other words, if you had $1,000 today and it was earning you 2% a year, every year, it will not turn into $2,000 for 36 years. Now, that is a ridiculously long time to wait for your money to grow. Now, if you can find some investment that could actually grow at a faster rate, if it could grow at 7%, then it will take 10 years for the money to double. Now, obviously, Brendan is right. 2% is guaranteed, 7% there is risk. But are you willing to take that risk? So going back to your question, I know it's a very long-winded way of answering your question, Richard, but the answer is, if you haven't got the time to do it yourself, then think about, something else. Think about, some of those funds that are being offered by the banks or by institutions, but accept the fact that they're going to charge you for doing it. If the Singapore market is going to return, say, 8% a year, and they are going to charge you 3% for managing your money, you will only end up with 5. 5 is still better than the 2 that Brendan is talking about, and that is probably why I would say for some people it is the right thing to do. For me, I don't want to give the bank the 3% for managing my money. I would much rather have the other 3% myself, so therefore I'm willing to learn, and I will actually sort of take the whole 8% myself, which means that my money will double in 9 years, right? So that is the way I think about it. Now, if you want an even cheaper way of doing it, you could go down the route. I know Alvin is actually a big fan of these. These are exchange-traded funds where the fees are a lot lower, and you will probably get a much better return, total return that is, than putting it into a fund, because the exchange-traded fund is not taking 3% fees from you. If the market returns 8%, you probably get, I don't know, 7.5% roughly. Yeah, so only 0.5% goes into managing that. And that is why many of the fund managers will never, ever be able to beat the stock market, because they've already taken 3% of your money. So therefore, if you put $100 in, only $97 goes into the market, because the $3 has gone into his pocket. Plus, every year, they will actually take more fees out as well. So that's my long-winded answer to your question, Richard.
Do something better than don't. All right, I think we're running out of time. What I'm going to do is just a quick roundup. I'm going to start with Brendan and ask in terms of, and each one to share in terms of one parting comment from each of them, from their point of view, to help you to be better investors. Brendan, please.
Well, if any of you all happen to be attending my talk or whatever, you always notice I always end up with one saying by this person called Lao Tzu, right? He says this, right? A journey of 1,000 miles starts with the first step, right? If you have not been investing, please do so, because investment is one of the key to ensure your financial future, all right? Investing transaction fee has come down very significantly, all right? 20 years ago, it was 1% one way, right? And right now, it's what, 1/4 of it, yeah? So it has come down very significantly. And if you do not capitalize on that, well, I think you probably have missed some opportunities. Yeah?
David, one parting comment for these
Okay,
to become a successful investor.
Okay, I'll be very, very quick. Whenever I look at a company, whenever I look at a stock, whenever I look at a market or a country, the one question I ask myself is this company going to be bigger or smaller in 10 years' time? That is the time frame I use when I invest. So whichever company I look at, whichever company you have in Singapore, take ComfortDelGro. Is it going to be bigger or smaller in 10 years' time? If your answer is bigger, then that is going to be a good investment. If your answer is smaller, then that is not going to be a good investment. And if your answer is, I don't know, then definitely don't invest in it because you have no idea. But if you are confident that this company is going to look bigger in 10 years' time, then by all means invest a small amount of money and then just let the company take its course.
Alvin, one last comment talking about sharing one tip for every one of them to be successful investors.
I think everybody is waiting for a stock tip, right?
They did ask. I just
okay.
eliminated them.
Oh,
That's all.
I see, okay. So if I can give you one, I think it's always good to start with STI ETF as, you know, as a first step, like what Brandon said, right? So that will be your homework to go and really understand what ETF is or what STI is and how you can actually start investing in that. Yeah, that will be my parting message. Thank you.
Ladies and gentlemen, thank you very much. We've got more questions, but we'll be trying to, we don't have time today to answer them. We're compiling them and putting up on the website. We'll be sharing this up. Everything is being recorded today. Could you please give a round of applause to our guests today? Brendan, David, Alvin, thank you for coming.